Okay guys, hope you're having a lovely day. Today we're going to be going through how not to round trip this cycle. I'm going to give you the frameworks for profit taking so that you can make and secure your profits this cycle. Let's get into it. Content, exits define your gains, battlefield signals. We're going to be going through funding, open interest, and liquidations. So I'm going to give you actual tools that can help you take profits and understand when the market's overheated. We're going to go through liquidity tracking, so chain net flows, how to track liquidity from chain to chain. This will help you understand when liquidity is exiting or entering a chain. We're going to go through the consensus delusion, so why people are delusional in consensus and sell the news tops, the myth of time in the top, profit taking is a muscle, new market terrain, fragmented liquidity. This is a sad one, but we're going to go through I'm going to give you guys the real truth here. I'm not going to sugarcoat anything for you. We're going to go through the action protocols and survival checklist as well. So let's get right into it. Let's start with exits define your gains. So like I said, in crypto, to make money, you have to make two correct decisions, not just one. Okay, so you have to be right twice when you enter and when you exit. Most spend their focus on the first step. They research coins, entries, and hunt for the bottom. But then they completely neglect the second step, which is why most round trip the best trade. Most people are just focused on the buying part. They don't think about the selling part. Unrealized P&L means nothing. Paper profits are not real. They are only exposure. Until you move these profits into stables, the market can take it all back. The best people in crypto internalize this truth. They know a P&L showing plus 500% means nothing if you don't exit. Retail learns it only when their P&L collapses back to zero. It's very, very true. Oftentimes takes a lot of pain to learn, but I hope you guys can skip that pain by watching my videos. I mean, I've gone through a lot of pain. I've learned it all in crypto. I've been in crypto since 2017. It's been a long time. So I really hope that you guys can kind of skip that painful step and just learn the first time. Learn from my mistakes, guys, okay? The allure of holding through periods of euphoria feels safe because the majority is with you. Okay, we're social animals. We like to be on the side of the herd, don't we? But the majority don't know best because it's a PvP market. Consensus creates liquidity for smarter money to exit. Discipline is not holding forever. It's stabling up profits while there are still buyers to hand you your exit. So true. You have to do the opposite of your monkey brain. When consensus forms, you sell. When consensus doesn't form, you buy. Survival, not bragging rights. Profit taking isn't about calling the exact top or flexing screenshots. It's about survival across cycles. Every major run redistributes wealth from the greedy to the disciplined. The trader who scales out into strength lives to fight again and lives to see better entries. The one who refuses to sell becomes the exit liquidity for everyone else. That's just how the game works. Okay? So, the importance of taking profits and don't hodl. Have to take profits. But how do you take profits? Well, we'll get into it. Battlefield signals. Fund and open interest in liquidations. We're going to get a bit technical here, guys. So pay attention. Funding rates is froth. So funding rates are, when funding rates are sustained at very high levels for too long, it's not strength, it's green. So funding rates are essentially a sign of how many people are putting on longs and how many people are putting on shorts in the market. If funding rates are high, it means that people have been putting on a lot of longs in the market. And this means that people are very bullish on the market, and people stay bullish on the market for sustained periods of time. It's one of the clearest signs of market euphoria, right? If everyone's long in the market and no one's short in the market, it means that the market's very euphoric. And if this happens for a sustained period of time, you have to be careful, okay? That's essentially what I'm saying here. Open interest. What is open interest? I've realized that I didn't even explain what it was. Open interest is basically how many trades are happening. It's similar to funding rates, but slightly different. So if open interest is really high and like tons of people are putting on trades, it signals that there's a lot of interest in trading. And that generally means that we're approaching euphoria. If we have a large spike of open interest for a long period of time, you've got to be careful. So if you get what I just said, it's a signal that the market is getting overexcited, and this leaves the market vulnerable to downturns. When open interest is extreme, even the smallest down move can trigger a liquidity cascade. Liquidation cascades. I think you guys have heard of this one before. It's great. Oh, actually, let me show you the funding rates while we're at it here. So This is Bitcoin's daily chart, and you can see the funding rates here. Now, this is only over a day. I probably should have shown you a week, but you can see that the funding rates go up and down with the market. Right now, funding rates are fairly high, but they're not crazy high. If we get sustained high funding rates for a long time, you've got to be careful. Heavy liquidation cascades are an excellent market signal. So today, 22nd of September, we actually had a very large liquidation cascade here. It was about about $230 million worth of longs got liquidated. And it's a very, very good sign. So when the chart lights up with liquidations, you're not looking at you're looking at a battlefield soaked with blood that you can take advantage of, whether that's a bullish or bearish liquidation. And I'm going to be posting where you can find these charts in the description below for on YouTube, okay? The combined read. So what you should do is you should use these signals together. High funding rates and very high open interest and large liquidation cascades give you important data on the market. The best combo is sustained, very high open interest and funding rate. These do not mean buy the dip, they mean danger. That's the time to take risk off, not size in. So I implore you guys, if you're on YouTube, check the link below. I would have the URL for the funding rate and liquidation cascades and open interest below, okay? Liquidity tracking, chain net flows. Flows dictate narratives. Coins don't move on beliefs alone. They move when liquidity flows into the chain they live on. If capital is bridging in, your coin can keep running. Chain net flows are actually one of the biggest and only leading indicators that we have in crypto. For example, if I see that a chain has just bridged into another chain, I know that that other chain is going to have a load of runners, a load of coins that are going to do well on that new chain. So it's a leading indicator. I see the indicator before the event happens, and this is the best type of indicator. So if flows dry up, even the best narratives will stall. So liquidity is oxygen. Without it, price dies. So if you see liquidity start to come out of the chain that you have coins in, you might start to want to take some profits. Reading the inflows. Spikes in net inflows are powerful short-term signals. So they mean new buys, new capital, fresh momentum. It rarely lasts. When inflows peak, you're often looking at a local top. Very good point. That is the point to skim profits soon, not size in heavier, okay? Like I said, outflows begin. It's usually too late. Prices go down quickly because attention follows money. You want to benefit from the crowd coming in, not be the last person holding the bag. So I'll give you an example here. Very good example with Abstract. I'm also going to send you a link of these chain net flows below in the description. So when Abstract saw its largest bridging inflows, meme coins on that chain locally topped. They later recovered, but the large inflow spike was the warning. If you were smart and watching net flows on Abstract at the time, would have given you the chance to take profits while others believed the run would never end. So I really implore you guys, have a look at this, have a play around. You can change the time frames. You can change a few things on there. It's very, very good. The consensus delusion, sell, the news tops. The consensus traps. When a coin is suddenly talked about as a blue chip, danger is close, especially if it's a meme coin. Consensus only forms after parabolic moves, not before. By the time everyone agrees, the asymmetric upside has already been captured. This is what feels like safety is usually saturation, okay? So when everyone's saying Popcat's the beta to Sol, when everyone's saying that Popcat is the best meme coin on Sol and meme coins are the future, when everyone's saying that Bitcoin's going to have a super cycle and we're going to go to 400K this cycle, consensus, okay? You got to be careful. Euphoria as a signal. At the peak of Popcat, traders called it a safe Solana bet. Like I said, it was marketed as the beta to Solana. At the peak of Sol itself, even the likes of Bob Lucas, who's a very experienced crypto trader, called for 1,000 Sol. Both moments marked exhaustion. Even when the smartest minds join retail and repeat in the same script, it's no longer conviction, it's most likely distribution. That's what actually happened with Sol and Popcat. So if we have a look at Popcat here, with this big rally up, we had this exit liquidity area where Popcat became consensus. It was above $1 billion in market cap. And then after a while, it got completely flushed and went down 94%. If you bought up here, you would have been in trouble. Big, big trouble. And the funny thing about this is that you're most likely to buy at the top because that's when most people are marketing the coin. So it's especially dangerous. That's what makes crypto so dangerous. You're most likely to buy at the worst time. You guys have to internalize this. Sell the news events. Big headlines often mark local tops. A Binance listing, a celebrity coin, a high-profile partnership. The reality is that insiders know these events before they're public. They buy in early, then offload into the announcement. Retail thinks the news is bullish, but it's just providing exit liquidity for those already in. That's why you have to be so careful with these events. Why it works. News doesn't change positioning, it just reveals it. If you hear about an event on Twitter, a group of insiders definitely heard about it. In public, they made the news, so they're going to buy in. So if news spikes a coin, it means that insiders are already in, and they're probably going to sell on that news, okay? The professional's mindset. Professionals don't cheer headlines, they sell them. By the time consensus is loud and news is mainstream, you should already be scaling out. The best traders turn hype into exits. Retail turns hype into bag holding to zero. Very, very true. So, the myth of timing the top. The fantasy. Everyone dreams of selling the exact top tick. It never happens, guys. It never happens. Like, waiting for perfection is how most people end up round tripping. Just get this out of your head right now. You're not going to sell the top. The trap. Most miss the top, and then they get an ego, and the ego convinces you to try again at a second time. But what if that never comes? And what follows is months of denial and pain. You guys may have been there. So what you should do instead is don't chase perfection. Aim to capture the bulk of the move. If you manage to capture 70% of the move, that's great. That's really, really good. And that's enough to change your net worth. You don't have to get it perfect. Just capture enough of the move. That's all you need to do, okay? So you can only see tops in hindsight. And the moment you found one, you're probably too late. So your job isn't to catch the top. It's to sell at a decent point when you think the market's overpriced the asset and there's consensus about the coin and you think that the asymmetry is now negative, and to have enough liquidity for the next play, okay? Profit taking is a muscle, a learned skill. Most traders think profit taking is an instinct. It isn't. It's a muscle. If you don't train it, it stays weak. It's just like a muscle. The more you train your muscles, the bigger they're going to become. So you have to just sell small, guys. Start selling like 3% of your coins, okay? Train that muscle because it becomes easier. Retail never takes profit, so they never work the muscle. So when it comes time to actually sell, they won't. They'll just hold because it's easier, mentally easier. It's just the way our brains work. Case study is a bit of a painful one for me. RSR in 2021, I rode RSR massively. Really, really big, super big return on it. I failed to sell. I gave back all my gains because I hadn't built that muscle yet. And it was a brutal lesson. Profit's only real when you convert the coin into stables. P&L doesn't pay the bills. USDC does. Write that down. P&L doesn't pay the bills. USDC does. Ego versus discipline. For some reason, retail thinks selling is a weakness. They wait for each leg higher. But in reality, you should reframe it as taking profit as a strength. Each exit increases discipline and makes you more money and keeps you solvent for the next play. Because there's always going to be a next play, guys. Always. Just don't lose all your money. Okay? The new market terrain, fragmented liquidity. Oversupply of tokens. In past cycles, attention in alt was concentrated on a smaller set of tokens. Now there are literally thousands of coins launched weekly. This oversupply spreads liquidity thin, shortens the lifespan of each narrative. And that's the sad reality. 2021, there was not as many altcoins. We didn't have Pump Fund, we didn't have Bonk Fund, we didn't have all these crazy token creation dApps, decentralized applications. Now in this new bull market that we find ourselves in, 2023 to 2025, crazy amount of liquidity fragmentation because there's just been so many tokens created. So like I said, like liquidity spread thin, you get fragmented attention, which we're going to go into. Traders don't stay locked into one ecosystem for a long time. There's more ecosystems too. Last cycle, it was literally just Ethereum and Sol. Now it's tons. It's like Ethereum, Base, Arbitrum, Abstract, Aptos. There's just so many. So what could be a stronghold today can be forgotten tomorrow. Shorter narrative cycles in 2017 and 2021, you could hold alts for longer stretches. Today, the window to extract gains is shorter. Coins pump harder, but they also die faster. Intracycle profit taking isn't optional anymore. It's survival. You must be taking profits intracycle. You can't just hold a coin from the very beginning and sell it at the end unless you're holding Sol, ETH, or Bitcoin. So Bitcoin remains one of the only tokens that you can trust that actually hold for the whole cycle. A few select altcoins are good for full cycle holds, but you should not be holding the rest for long. Adapt or get crushed. The bull market of 2023 to 2025, the one I'm recording this video in right now, has changed. Applying old strategies in this market is a blunder. If you learn anything from history, you'll learn that the people that don't adapt are the ones that die. And if you want to adapt into shorter market cycles and thin in liquidity, you're going to give everything back. So the best traders have evolved. Retail has been losing money. Pick a side, adapt. Okay, guys, let's get into what you guys are going to be doing, because I threw at you a ton of information. So let's just distill it down and give you guys actual actionable steps. Okay, so action protocols and survival checklist. So number one, define the thesis. Enter positions with a reason. Exit once that reason is achieved. No new excuses. Monitor battlefield signals. Funding, open interest, and liquidations. Expose overheated markets. Cut risk when they flash red. Watch liquidity flows. Inflows fuel rallies. Outflows kill them. Scale out when flows peak. Fade consensus. Blue chip talk means saturation. Exit when retail feels safest, like they did with PopCap. They felt safest at the top. Sell the news. Listings and hype events are insider exits. Don't be the buyer, be the seller. Stop, time, and tops. Capture the bulk of the move. 60 to 70% is enough. Okay? Don't try and sell the fucking top. Just capture the bulk. Exercise the profit-taking muscle. Skim profits often. 3%. Take 5% off. Repetition builds the reflex to sell without hesitation. Adapt to the new terrain. Most altcoins shouldn't be held through cycles. Only Bitcoin through cycles because of fragmentation of liquidity and too many tokens and fragmentation of attention. Survival over bragging rights. Secure your war chest. Don't round trip. Cycles don't reward perfection. They reward survival. Profit taken is what keeps traders alive when everyone else is bleeding. Hope you guys enjoyed that. If you have any questions, leave them below in the comments, and I'll see you on the next one. Bye-bye, guys.